Hello candidates and welcome to the financial management lesson. We are on the topic business stroke financial asset valuation models. We are on subtopic 5.6. In our last session, we learned how to value ordinary shares using Walter's model, finite earnings growth model, Gordon's model, price earnings ratio basis, net assets basis. Today we are moving to the discounted free cash flow method. Discounted free cash flow. Discounted free cash flow. Discounted free cash flow. Discounted free cash flow is another technique that can be used to value ordinary shares. It is a valuation method that estimates the intrinsic value. It estimates the intrinsic value of a company based on its projected future free cash flows. Based on a company's future free cash flows. Free cash flows. And free cash flows is the cash that is generated by a company's operations after accounting for capital expenditures and working capital changes. After deducting the capital expenditure and the working capital changes, we have what we call free cash flows. Free cash flows. And there are two distinct approaches that we use in free cash flows for evaluation candidates. There are two approaches. And the two distinct approaches to using free cash flow for evaluating the future cash flows valuation approaches are the free cash flow to the firm. There are two approaches. The first one is free cash flow to the firm. 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 Then there is the free cash flow to equity. But let's first consider the free cash flow to the firm. Now, the free cash flow to the firm, the free cash flow to the firm is the cash flow available to the company suppliers of capital after all operating expenses, including taxes, have been paid and the necessary investments in working capital like inventories and fixed capital like equipment have been made. So it is the cash flow from operations minus capital expenditures. So it is the cash flow available to the company's suppliers of capital. It is the cash flow available to the suppliers of capital, to the company's suppliers of capital. It is the cash available to the company's suppliers of capital. Those who supply capital, like the venture holders, the equity shareholders, those who supply capital. That's what we are referring to free cash flow for the firm. The firm, all the suppliers of capital, the cash flow available to the company's suppliers of capital. And we said it is the cash flow from operations minus capital expenditures. Free cash flow to the firm. It is the cash flow available to the company suppliers of capital, which include the stockholders, the bondholders, the preference shareholders. So those are the suppliers of capital. Number 2, free cash flow to equity. Free cash flow to equity. Free cash flow to equity. Free cash flow to equity is the second approach under the discounted free cash flow valuation method. Free cash flow to equity is the cash flow available to the company's holders of common equity. It is the cash flow available to the holders of common equity. It is the cash flow available to the holders of common stock, the ordinary shareholders. After all operating expenses, interest, the principal payments have been made or paid, and the necessary investments in working capital and fixed capital have been made. So the free cash flow to equity is a cash flow from operations minus capital expenditures, minus payments to debt holders. So do you see the distinction, Candice, between the two? This one is the cash flow available to all the suppliers, all. This one is free cash flow only available to the shareholders, the common stock holders. So then, what is the present value? What is the present value of free cash flow to the firm? What is the present value of the free cash flow to the firm, the first one? Now, candidates, the free cash flow to the firm The free cash flow to the farm valuation approach estimates the value of the farm as the present value of future free cash flow for the farm discounted at the weighted average cost of capital. Please pay attention. The subject is financial management. We are studying valuation, business valuation models. We are at a point when we are studying how to calculate the value of ordinary shares. We are on the technique discounted free cash flows. There are two approaches: the free cash flow to the firm and the free cash flow to equity. We are now moving to the nitty-gritties. We want to calculate the present value of free cash flow to the firm. The free cash flow to the firm. Now I'm saying that the free cash flow to the firm valuation approach, there are two approaches. So this first approach estimates the value of the firm as the present value of future free cash flows to the firm discounted at a weighted average cost of capital. So here, candidates, the firm value. I've used sentences. Let me now put it in formula, in form of F of the present value of future cash flows for the firm. So we're going to take the future cash flows for the firm. We discount. By dividing, we are discounting. We discount it by using the weighted average cost of capital as a discounting rate. That will be 1 plus weighted average cost of capital. Weighted average cost of capital. We are taking the average of the different sources of capital, because here we said that this free cash flow to the firm is a cash flow available to all the suppliers. So we are taking all the suppliers, the cost, then we are weighted. So this is the future cash flow to the firm. Then we discount it using the weighted average cost of capital. Then we need to raise it to either N or T if you like. If you are getting the present value for cash flows for 5 years or 10 years, this is the period. So FCFF is the future cash flows to the firm. WACC is the weighted average cost of capital, and T is the time periods from 1 to maturity. And I've explained why we are using the weighted average cost of capital. We are using the weighted average cost to discount the future cash flows for the firm, because we are dealing with all the suppliers of capital. So therefore, candidates, because future cash flows to the firm is the cash flow available to all suppliers of capital. Using the weighted average cost of capital to discount the cash flows gives the total value of the firm's capital. So this is a weighted average cost of, and this is how it is calculated. The weighted average cost of capital is equal to the weight of equity times cost of equity plus the, let me put it the other way. It is the weight of equity times cost of equity plus weight of debt times cost of debt 1 minus t. That is how we calculate the weighted average cost of capital. These are two sources: equity, the owners, and these are the debt holders. It's the cost of, so we get the weight. These are the weights. This is to the firm. Then we need to calculate the present value of future cost, cash flow to equity. Cash flow to equity. What is the formula? Equity value will be equal to the summation of the future cash flow to equity. We divide by 1. By dividing candidates we are discounting plus cost of equity raised to t or n. So because we are calculating the present value of future cash flow to equity, the discounting rate here is cost of equity. And here, because we are discounting the future cash flows for the firm, for all the suppliers, then we get the weighted average cost of capital for the different sources of capital. So here we have the present value for the firm. Then there is here the equity value. What will be the firm's value? What will be the firm's value where there is constant growth future cash flow for the firm? Constant growth. Let's begin with the first one. Future cash flow to the firm valuation model. Now, assuming that the future cash flow to the firm grows at a constant rate, such that the future cash flow to the firm in any given period is equal to the future cash flow to the firm in the previous period multiplied by 1 plus G. Now, where there is constant growth, where we have constant growth, then the firm's value at a constant growth, the firm's value will be equal to the summation of future, free cash flow to the firm, free cash flow to the firm, then we grow it at the rate at which is growing, 1 plus G. Then we divide by the weighted average cost of capital minus G. At constant growth, that is the firm's value. Then at constant growth, what will the constant growth in relation to the free cash flow to equity? Free cash flow to equity, the equity value will be equal to the sum of the present value of the future, free cash flow to equity 1 plus G divided by KE minus G. And future cash flow to equity of 6. We have to calculate the firm's value. The formula, we have it, summation of free cash flow to the firm candidates. Do we have the inputs, the firm's value? Do we have the free cash flow to the firm? The question reads, Siagi has free cash flow to the firm of 700 million. So that is 700 million. Have you seen that? 700 million. 700 million. This we have it in the question, 700. We have also the rate. It is growing at 8%. The growth rate we are given, the growth rate is 5%. Is it 5%? Did I read 5%? What is the growth rate? The company expects a target. Siagi has 700 and 600 before tax. Cost of debt is 5.7. Equal rate of return is 11.8%. The company expects a target capital. Then we read it's expected to grow at 5%. Yes, 5%. So you'll have 1 plus 0.05. We divide by the work. We do not have the work, but we have the values. We have the values. Siagi has 700 million. That is FCFE. Then we have 620 and FCFE of 620. Before tax is 5.7. Equal rate of return 11.8%. The company expects a target capital structure consisting of 20% debt and financing, and 80% equity. Those are now the weights. We have the weights there, candidates. 20%, 80%. So we are going to calculate the work, and we have the formula here. So the proportion of equity, is it 20 or 80? Is 80. So this is 0.8 or just 80%. What is the cost of equity? The cost of equity from this question is, what is the cost of equity? The cost of debt is 5.7, and the cost of equity, is it 35? No, 11.8. Cost of equity is 11.8. This is 11.8. That is cost of equity plus the weight of debt. The weight of debt is 20%. The cost of debt we are given at 5.7. Do you see that? The first sentence, second sentence, 5.7. Then we have tax rate. What is the tax rate? The tax rate is 35%. So this will be 1. We multiply 1 minus 0.35. Give me the work. This is how to calculate the weighted average cost of capital. What is the work? 10.18%. Please confirm. So if the work is 10.18, then we have here 10.18 converted into decimal 0.1018 minus G 0.05. So the answer here will be the value of the fund. 14,189,000. Is that so? We are putting decimal places, but these are millions. This is 700 million. That will be the value of the firm. And candidates, we know that value of the firm, we know it's equal to value of debt of equity plus value of debt. This is true. The value of the firm, the whole firm, will be equal to the value of equity plus value of debt. Now, if the value of the firm is 14,189, and from the question we have the value of debt. What is the value of debt from the question? What is the value of debt from the question? The value of debt from the question, you can see down there. Has debt outstanding with the market value of 2.2 billion. 2.2 billion. So I think, Lincoln, you have the right figures. It is 189, 189, 190. 190. These are billions. If the value of the firm is 14,189,109,190, this one here, 190. This is the total value of the firm. The total value of the firm is equal to the value of equity plus value of debt. So if we have the value of the firm and we have the value of debt, 2.2 billion. $89, 190 minus 2.2 billion. How much is it? 11 billion 989. This is the value of equity, total equity. But candidates, we are learning how to calculate the value of a share. If this is the value of a total equity, then what will be the value of one share? This is the total. Therefore, value of a share, one share, will be equal to total equity. We divide by the number of outstanding shares, which is equal to the 11 billion 989 million 189,190 shillings. We divide by the number of shares from the question, 200 million outstanding common shares. So we have 200 million outstanding shares. That will be the value of a share. How much? What is the value? 59.95 is the value of a share, using the first approach. The second part of the question, value of Siagi's equity using the free cash flow to equity valuation. Free cash flow to equity. So then, what is the future free cash flow to equity from the question? 700, then free cash flow to equity is 620 million. 620 million, we grow it, 1 plus 0.05. We divide it by the cost of equity. The cost of equity is the required rate of return. The required rate of return of 11.8. Converted into decimal, 11.8 is 0.118 minus 0.05. What is the value of equity? It is growing at what rate? Look at the third last sentence. The free cash flow to equity for Siagi is expected to grow forever at 8%. So this one is growing at 8%. It is growing at 8%. It is growing at 8%. The first one was growing at 5%. So what is the equity value? 17,621,052,630. Please confirm. So what will be the value of equity? Equity. So then, equity value will be equal to the firm's value of 17,621,052,630 minus 2.2 billion, which is equal to 15,421, 0.52. These are fresh as figures. 6.30. So what will be the value of a share? Value of a share will be equal to the equity value of 15,121,052,630. We divide by the 200 million. $77.11. We are calculating the value of the firm using the two approaches, FCFF and FCFE. The 17 billion is the value of the firm using FCFE. The other one was the value of the firm using FCFF, the total value. And we know that the total value of the firm is equal to the value of equity plus value of debt. The value of debt is provided in the question. So if the value of the firm is 17,621,000,000 and the value of debt is 2.2 million. Is it 2.2 million? 2.2 billion. This was 2.2 billion. Then the value of equity is just the difference. Then we divide the value of total equity by the number of shares to get the value of a share.